Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining our online meetup. We're very excited to have Sandhya join us today for our episode number 18, where we focus on getting started as a passive investor in multifamily syndications. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. Again, my name is Marcelo Cazini. My background is in IT and software development with an MBA from Texas A&M. And I'm a local Houston CCIM member here with all of the CCIM designation trainings. I'm a multifamily investor, and I also own and operate my own commercial real estate. And I've also done single family fix and flips before getting started with multifamily.
Thank you, Marcelo. My name is Claudia Rubio. I was born in Colombia, in South America, where I got my architecture degree. And my background in asset management comes from Colombia, managing our own assets. Before we got married, and then after we got married, we started doing more real estate related businesses. I have a National Apartment Association certification, and that's it.
I'm Martin Rubio. I'm an IT security consultant. I've been doing that for over 25 years. Before in Colombia, as Claudia mentioned, with my own consulting firm, we built several businesses around it. Also some businesses related to real estate, hard money lending. So my background is more on the business side. We started working on multifamily around almost 2.5 years ago. And we have invested passively in several deals. We have closed in our first syndication in last December here in Houston. So we have invested total in around 800 units in different markets. That's our experience in multifamily.
Perfect. Thanks, Martin. And Sandhya, do you want to go ahead and introduce yourself?
Hi, I'm Sandhya Seshadri, and I have lived in the Dallas-Fort Worth area for over 30 years. I came here as a student to go to college at SMU, and after that, I got my job at Texas Instruments, where I worked for about 14 years. And then I got into the stock market because TI paid for me to get an MBA part-time, which was great. So I got into the stock market quite a bit after I had kids. And a couple of years ago, when our president took over, I think we all knew that he paid zero taxes. And I was really interested in getting into real estate, just didn't know where and how, but I wanted to reduce my tax burden. And that's what led me to real estate. I had stayed away from single family because I thought I would have to manage it on my own. And if I lose a tenant, I lose 100% of my revenue. And I didn't want to self-manage and worry about being called in the middle of the night or during Thanksgiving dinner to fix a leak, that kind of stuff. But when a friend told me that, I didn't have to be a billionaire to go buy apartments, that there is something called syndication and there's passive investing, that got me really interested. So I started out, I invested in a deal passively in someone else's deal that this friend told me he knew really well. I got introduced to the syndicator, and his deal had done well before. So I was interested and I invested in it. And then I attended one of those weekend events by a famous mentor in the Dallas area. And I was hooked right from there. I said, this is something I really want to know more about. So I joined his mentoring program, after which I also joined a couple of other different mentoring programs, all related to multifamily. And it's been a great experience. I get to network a lot with people in this business in like-minded ways and learn a lot from all of their experiences and their mistakes. It's like a membership to a country club when you join one of these mentoring programs. So you get immediate access to a wealth of knowledge that you can't always find in books. And that's where repeatedly going to these types of events last year, I met some folks who I really connected well with. And together I partnered with them to do my own syndication. Because as a first timer, and using other people's money, I didn't want to take a chance and try to do it myself and learn from my own mistakes. I wanted to go with an experienced team member or team members in this case, so that I can leverage their experience to grow. And that's how I got into multifamily, is through passive investments and then joining others with experience to syndicate a deal.
Perfect. Thank you, Sandhya.
Okay, so let's get started. Sandhya, you just mentioned that you went straight away into multifamily instead of going the single family route. But what else other than tax benefits attracted you from multifamily?
I wanted to diversify my portfolio from the stock market into real estate, because every rich person I had ever met had something to do with real estate. Every person you read about usually has a hard asset that makes them richer. And I'm originally from India. And in India, for sure, that's one of the ways that we build wealth is like my parents, as they're older now, they depend on that rental income to come in every month. So it's always been one of those things, it's a building, it's a hard asset, it's steady cash flow that you get regardless of the fluctuations of the stock market. So I was always interested in it. I just didn't know much about maintenance to take care of a house. And that's why I didn't go to the single family rentals. But when someone told me, hey, you can have a third-party property management company who will take care of all of that for you. And that's why apartment business is attractive. It's also because you get to enjoy the benefits of scaling, that I was like, okay, I need to learn more about this. And what better way than to do passive investing, because you get to enjoy some of the benefits and gain the knowledge, but without taking on all the risks and the sleepless nights, all of that yourself. And it doesn't take up any of your time once you invest passively. So the only thing you have to do up front is do your homework or due diligence on the sponsor and the deal itself, and then you're done. Because then you just enjoy that cash flow without the headaches of running a property yourself.
Right.
Yeah, for
right.
sure.
You just mentioned something important, that a passive investor also learns a lot about the business once they get into one deal. Mm-hmm. They start getting the reports and they get a lot of information that you learn once you're a passive investor. That's true.
So
Learned a
Sandhya,
tremendous amount investing with a variety of different sponsors. You find their style, you know what you like, and you pick what you like from each one, every one of them, and you take notes and you sort of say, when I do my own deal, I'm going to do it like that, and I'm going to report on that, and I'm not going to make that mistake or whatever else. So now suddenly, you are this little, you have your own little encyclopedia of things to do and things not to do, just from investing passively and without the stress of it. Because when you're new to something, I feel like to not take on all the stress, but just focus on learning is better. And so when you're passive, you get to do that, but you also have given someone a lot of your hard-earned money. So you get to ask them questions. So when you get those reports, I try to invest in places that are close to where I live. So then I'll start asking the sponsor, hey, when are you going to go visit your property? Can I come along with you? Can I learn this from you? Because I wanted to know the business more, but I wasn't quite ready to take other people's money and sponsor a deal myself. So that's what I did as a passive investor, is I learned the business. It's sort of like a trainee, tagging along with someone and being a second pair of eyes. Whether it's reading reports and arranging calls with them to ask more questions, or physically visiting the property. Like passive investing, it's like the practical training. Once you've gotten your video and your book knowledge, it's like you see it come to life when you see a property and you invest in one. So for me, it was the greatest knowledge builder.
Yeah,
that
I think
translated my textbook knowledge to reality. It's like you go to college and you read a lot of books and you see a lot of simulations. Now you're in the corporate world. You have a real job. This is real things happening, real projects, right? It's the same concept. By investing passively, you go one step closer to that. You're now an intern. Mm-hmm. Yeah. Then you're ready to be running that project yourself. So I think it's one of the best intermediate steps to learn the business.
Yeah, and even if you don't want to become a sponsor later on, you just want to stay passive. Mm-hmm. That's a great approach. And besides meeting sponsors, meet other passive investors, because you're going to learn from their experiences. You're going to ask, what was your experience with this sponsor that I don't know about? So that's pretty good. So on the education side of things, which I think all our guests have agreed that that's one of the most important things to get education before jumping in the water. We know we're in Brad's group. Before joining Brad, did you have any other education on multifamily, like books or podcasts or anything like that, or the first thing you approached was Brad's group or a mentorship group in general?
The first step I did take was Brad's group because he was established in Dallas, and that's where I wanted to be, and I wanted to do deals here. So I looked around, and there were a couple other options I had for mentoring programs, but I wanted to find the one that had the most deals in Dallas, that was well established with brokers, etc. Because as soon as I joined Brad's group and then I started underwriting deals and talking to brokers, I got so much respect just from saying that I'm part of a group. We know what we're doing. I'm going to team up with someone with more experience than me. And those things added a lot of clout, and people took me seriously when I went with the brokers and I established those relationships. But I didn't stop there. I did join a couple of other people as well. I started going to a lot of the local conferences. It seemed like Dallas was a great hub, and so is Houston for a lot of conferences. So I met people from various mentoring groups. I got some marketing help from Adam Adams, who's really good at if you want to market yourself, build your website, do ClickFunnels, do all of that kind of stuff to grow your passive investor base to raise money. He's really good at that. I also teamed up with James Kandasamy, who's highly respected. He wrote the book on passive investing. So if you don't have that book and you're interested in learning more, buy the book by James Kandasamy for passive investors. It's a fantastic book. And so I follow him closely. I listen to his podcast. I also follow Joe Fairless. So there's a lot of gurus out there. Michael Blanc, Joe Fairless. Ron Cleef, to me, is more of a great motivational speaker. But when it comes down to the brass tacks of actually doing the job, I felt like I got more from, say, Michael Blanc, Joe Fairless, and Adam Adams, and James Kandasamy. Besides, of course, Brad Sumrock. Like I said, the big bucks I paid to Brad Sumrock are basically for the membership of the country club so that I know so many people. That's what you pay for, is the network that you build so that you don't have to make all the mistakes. You can just say, I think I'm having this issue. How do you deal with it? And you have coaches and other people who've probably done it. You have a Facebook group where you can post it, and it helps you. I don't know if I answered your question, but I said
Yeah, you did.
For sure.
Actually, you gave us a lot of important information for everybody to take notes.
So once you had access to the educational program and you started going through it, how long did it take you to feel prepared to go after that first passive investment? And how long did it take you to, when you were ready, how long did it take you to find that first investment to invest in?
So let me just say this. When you join the country club and you're a new member, you're almost like a honeybee, like, honey attracting all these flies. People find you when they know, okay, you're an engineer, you have a background, you have some money, you're new to the group, they find you. So the deals find you easily. And a couple of the deals, of course, it was from several conversations with the sponsors and feeling good about the sponsors. And I did check with my coaches what they thought of these sponsors. And they didn't exactly endorse them, but they said, as far as I know, this person has not had any bad deals and seems very knowledgeable. That's the kind of neutral but positive feedback I got from the coaches. So it was very quick to find my first deal within the group. I already had a deal outside the group before I joined the group. So this was sort of like my second deal within the group. It was very quick to find it. It was actually with one of the more highly respected people in the group, Raj Gupta and Darren. So that was my first deal with them. And I kept continuing to form relationships with a variety of sponsors. So Elaine, I think Elaine usually gets most of the newbies, at least in one deal somehow. He's very good at marketing. So I invested in his deal. And the deal is doing fine, so I don't have regrets. The one thing I also did was, because I had worked for over a decade at a company, but then I was no longer working there, I was able to take all of my retirement portfolio from it, convert it into a self-directed IRA, which eventually I put it into an EQRP, which is a type of solo 401k. So my retirement money, instead of being left in the stock market to someone to run that mutual fund or whatever fund that nobody looks at, I was able to actively sit on the driver's seat and say, okay, I'm going to put it in real estate. I'm going to put it in multifamily. So that's why I have so many passive investments. It's because your retirement money, you technically cannot use it to buy for your own deal. So that's the perfect use for your passive investments, is to take that retirement money, put it into other people's deals, use that as a way to build relationship with someone with whom you want to do a future deal. So let's say you like someone that you've met at a conference, you get to know more about them, you hear about their reputation. Have a checklist of, these are the things I want to see in someone or a deal, both cases, both the sponsor as well as the financial side of the deal itself. Make your own list of, this is what I need to see to invest my hard-earned money in a deal. And that's what I started doing with each deal. If there was something that I slightly didn't like, I said, okay, I'm going to make sure I fix that. So now I have a long checklist on how to vet a sponsor and also how to analyze a deal. And that's helped me a lot, because I still invest passively, because investing passively, again, like I said, gives me all of these benefits, but the additional tax benefit is depreciation. So if I don't find a deal in the next 1 or 2 months, I won't be able to close a deal for 2020. In which case, if somebody else with a strong reputation has a deal closing by the end of 2020, I'm probably going to put my money there just so I get some depreciation. So that's one of the reasons why you want to still have your own checklist to vet a deal as well as a sponsor, just in case those tax benefits don't come in time. I definitely don't want to lose out, because our lovely President Trump tax benefit may go away in a couple of years, regardless of who wins the election. So you want to make hay while the sun shines. So you want to maximize that this year and next year.
Yeah, so Sandhya, you mentioned your checklist there. For someone, we do get a lot of people who are still looking for their first investment here, their first passive investment. What do you think are some of the important things? What's your best advice for someone like starting right now, especially where we are with the economy and COVID-19? So what are some of the things from your checklist or where best advice there for someone looking to do their first investment?
Number one is to remember that this is real estate. So your cash is not as liquid as it might be in the stock market. So remember that once you give your money to a sponsor on a deal, it's going to be 3 to 5 years before you get your cash back. So don't get flustered by, okay, in a year I need that money to pay for something. Well, then real estate is not right for you. Real estate takes longer, but in the end, risk adjusted usually slightly at least beats the stock market in general. You want to definitely have 6 months of living expenses saved. So you have a plan for a rainy day, as I call it, your rainy day fund. If you lose your W-2 job or whatever is the major source of income in your family, you want to make sure you have 6 months of living expenses saved. And you want to remember that with multifamily or any other real estate, typically you don't get your principal back for 3 to 5 years. Once those two are set, the next most important thing is who's the operator or team who's running the project, right? Who's on the driver's seat? What is their track record? It's fine if they haven't done many deals in the past. It's more of a matter of what other 100 things do they have going on? Are they going to pay attention to your property? If they lack in experience, does one of their partners cover that? So that as a team, they have all bases covered. Like one of my partners has an experience with insurance. My other partner is very good at talking and marketing, etc. So he does a great job with raising capital and investor relations kind of things. But both of them together have run properties before to where they've made it successful. In my case, the way I was able to add value to them is that I'm the Dallas resident, 30 plus years in one area. I really know my neighborhoods, my submarkets, my streets. I know that one side of Garland is far better than the other side of Garland, versus somebody out of state might say, oh, Garland, Texas, that seems like a nice location. Well, I know the streets where there are the drug problems, and I know the nice side where, it's by the schools. So I know things to that level of detail. So I served as boots on the ground. Anytime anything was needed, hey, tomorrow morning, can you go be on property? Well, I'm there, right? So when projects were getting done in our multifamily, like we moved the main front office to another location, etc. I was there. When we did our water conservation program, I was there to meet the vendor. When we did our LED upgrades, I was there to meet the vendor. Anytime something is needed on site. So even though I was a newbie without experience, compared to my partners who had already done deals and closed deals and sold them, etc., I was able to serve a purpose for them to where they were able to take me on. So whenever somebody asks me, how do you get started? How can you add value to an experienced team member? Ask yourself that, because even though you may not have done multifamily, your experience in other places is still valuable. Your projects, your technical experience, your, like for me, being an engineer, my ability with numbers, my ability to analyze spreadsheets. So nowadays, I'm the one who's underwriting hundreds of deals. And then when one or two pass my test, then I'll say, wait, are you interested in this? So there's different ways that you can add value. But as a passive investor, the first thing you want to look at, save cash, know that there's no liquidity, vet that sponsorship team to make sure they've covered all bases. Who's my point of contact when there is a question? What is your track record? At least one of the sponsors should have done a full cycle on a deal, had some experience at asset managing successfully, ideally this year, right, through COVID. So if someone's coming to you with a new deal next month, ask them, who are you partnering with? How have their assets performed in the past 12 months? Did they underwrite it conservatively? Were they able to make distributions in 2020 despite COVID? Did they have to go for any kind of a forbearance, capital call? Did they have any kind of a bridge loan? How much in reserves did they keep? How aggressive or conservative are they in their underwriting in terms of reversion cap rate, which is another interesting financial to look for when you analyze deals. So a lot of these things, if you just start learning the terminology slowly, like a few terms at a time, and then apply it all, it makes it a lot easier. So there's tons of podcasts, of course, from which you can learn this as part of your entertainment while you drive every day. Say, I'm going to do 30 minutes a day, 40 minutes a day of a podcast, and that'll help me come get familiar with some of the terms that everyone's talking about.
And when you're looking at, probably not right now that the deal flow have reduced, but I know before COVID, if you're part of a group, it's normal for you to be getting 3-4 deals a week to invest, right? And a lot of them may be very similar from the surface. They're going to say 80% total return. They're going to say good cash on cash. What are some of the things that you look at it when you're analyzing it, or your top 3 or 5 items from a passive investor that you want to see on a deal before you decided to kind of look further on it?
The team's track record is very important to me. And the second most important thing for me is the location. Because real estate ultimately is still location, location, location. And this is nothing against Houston, but let's say I have a deal from Houston and a deal from Dallas, and in every financial way they seem equal, I'm going to pick Dallas. It's not just because I've lived in Dallas for a long time, it's also because I see the risk a little bit more in Houston. I feel like whether it's a floodplain, whether it is insurance costs may be more because Houston's known for its floodplain, it's a Dallas person's attitude as well. So unless there's a Houstonian, like the Rubio couple, right? They know their market. So if they were involved and it's a Houston deal, that's a different matter. But if it's people from other places who don't actually live in Houston, who are saying, here's a deal in Houston, I'm going to trust that a little bit less than somebody who lives in Houston and then presents a Houston deal, right? So if there's 2 deals presented by people from California, okay, and one is a Houston deal and one is a Dallas deal, I'm going to pick the Dallas deal. So market is important. Diversity of jobs in that location, meaning, you know, it's not just one employer that we're dependent on for the workforce housing there. There's going to be at least 3 of the 5 major categories of employers that we look for. So education, manufacturing, medical, military, corporate, you know, you make different categories like that. You want to have at least 3 of those covered in the employer base for that particular location. So your market analysis, so population growth, job growth, diversity of jobs, all of that is important. Median household income, right? These are some of the basic stats we look for in our market analysis of a place. So do I like that place? So when it's Dallas, I kind of know, okay, avoid a few of these pockets, but otherwise, you know, Irving, Las Colinas, Dallas, Plano, Richardson, Fort Worth, you know, the mid cities, the HEB as we call it, Hearst, Euless, Bedford, there are just a list of places that you know are really good markets. Same way, Phoenix is a great market, Atlanta is a great market, but have I done my homework of those two markets enough to know which suburbs or which areas are really good versus which ones are more risky? So crime rate is also important. So this is all part of your market analysis. So when you vetted the team and known that, okay, they have a strong track record of doing this type of deal. What do I mean by this type of deal? So there's a deep value add deal. That means maybe the property is not in such great shape. Maybe they're having a problem with tenants, low occupancy, etc. Right? And they're going to turn it around by making all kinds of improvements to it, changing out the tenant base, etc. Right? I called it a deep value add or a heavy lifting. Versus another deal might be more of a yield play, meaning it's stable to begin with. It's doing fine right now, but they're going to do some minor upgrades, interior upgrades, parking, things like that. Nothing too major. So I want to know if the team, if they present me with a deep value add, do they have an experience of having done that before? Because if they don't have that experience, why should I be their, scapegoat? So I try to make sure the team's experience covers the type of deal in that particular market. Another question to ask is, who's your property management company? Do they have experience in that market? Right? Citygate, for example, is a famous, wonderful property management company. They've done properties in Dallas, properties in, Houston, etc. Maybe they don't have a presence, I don't know, in College Station or in Abilene, as an example. Right? So I'd rather go with a local property management company than someone without experience coming into that market, even though they're great at what they do. So ask your sponsorship team as they present you this deal, who has verified these numbers? Do you have an actual lender's quote? Do you have a quote from your insurance company for that price? Has your property management company agreed to run your property for you with those numbers? Right? So everything they present to you, ask them, who agreed to this? Who agreed to this? That's a pretty simple question. Is that pretty good?
Yeah, great points. Wow. Yeah, great points.
Great information. So going back in time and with all the experience you have today, would you have done something different, or do you have any regrets and things that you've learned that you wouldn't do again as a passive investor?
Yes, as a passive investor, I would vet my sponsors more thoroughly, the way I just described to you, because I'm in a deal right now with two people who are considered highly experienced sponsors, but they haven't really done a deep value add before, and they are not familiar with that market. So that deal is not doing quite as well as it should. But I think in the end, I should get my principal back. I'm going to question whether it's going to get quite the returns that they pitched at the beginning. And, everyone sounds absolutely excited, energetic, positive, etc. about their deals. And there's no reason to not trust them, but there's also no reason to trust them, right? So you do a trust but verify model, as I call it. So I really want to believe you, but show me an example of where you've done that. I really want to believe you when you say, oh yeah, you can replace a boiler and chiller and it'll be fine, and all the leaks and all the problems will go away. But what about all the pipes? Do they go underneath? Have you replaced those? Have you checked for leaks? Has someone told you that none of the pipes are leaking right now and they won't leak for the next few years, even if you replace the chiller? So just things like that, you don't know. So you want someone to have that experience before you trust them with it. Otherwise,
you're dig down more on the sponsorship team. That's your
dig more into the sponsorship team to make sure they have the experience, as wonderful and nice as they may be, and they don't intentionally want to lose money, and they're sincere to you when they present the deal. But if they don't have that experience, why should you be their guinea pig?
Yeah, I think that's a great point, because for people starting, there are not every business plan is the same, right? Like you're saying, there may be some that they just want to get a property, raise some rents and keep running. There are some that they actually want to turn three bedrooms into 2 bedrooms or vice versa, and they want to do heavy lifting. So definitely the experience of the sponsor can vary, not just because they've done a multifamily before, that means that they're ready for the next multifamily that they're planning to work on, for sure.
And you talked a lot about the deal killers on the sponsor side, like what things about the sponsor will make you not to invest. What about the property? Like what things on the property that you've been presented to invest in will be a deal killer? Like the roofs, or what's your criteria on that?
Location is a huge one. Being on the right side of the highway, so to speak, because even if it's within a 1 mile radius, the median household income is high. If you're located on the wrong side of the highway versus the right side, it makes a very big difference. So today, especially if you're presented a deal and people are promising all kinds of rent bumps to increase the revenue in the first year, I would say that's a red flag. In COVID times, you'll be lucky to collect your rent. Ask them for their economic vacancy, not just a physical vacancy. Economic vacancy is related to the collections on your property. So for sure, if someone promises big rent increases during COVID and in the next 12 months, that's a red flag. Being able to increase rents is wonderful, and good luck to you to do that, but don't bet on it the first year, you know? It's a great thing if it actually happens, because then it's like a bonus, but don't bet on it in your underwriting and expect it to come through in the next 12 months. How can you, even if your rents are significantly less than the rents of the comp properties, your ability to get that rent while all this COVID is happening and all these eviction laws are in place, I wouldn't bet on it. And also I would wait for the election to see who wins and how that kind of changes your laws that go into effect. So I would be very, very conservative in my underwriting. And so if anything seems a little bit too good to be true, be skeptical. Ask somebody else to kind of give you a screen, like, you know, Marcelo, Claudia, they're great people. So if someone comes to you and presents you with the most attractive deal, kind of send it to them, say, hey, what do you think of this deal, guys? Would you invest in this? Do you know these sponsors, right? And certainly send it to me as well if you like. And I'll give you my 2 cents at least on the deal. And I'll tell you my version of what are the risks and what are the potential benefits that you might get from such a deal. That's the biggest red flag right now, is the rent increase. The second one is what's called the reversion cap rate.
Can you explain what that means?
Yes. The reversion cap rate is a prediction of the rate at which you will sell the property in 5 years. So today there's a certain cap rate at which properties are getting sold. In the Dallas area, let's say it's between 5.5 today. So what that is reversion cap rate. The cap rate is basically what is the net operating income that is generated by the property. So net operating income is revenue minus expenses, right? Revenue minus your operating expenses gives you the net operating income of that property. So let's say that the property's net operating income is $100,000 annually, and it's going at a 5% cap rate. So 100,000 divided by 0.05, how much is that?
20 million.
2 million, right? So that's the value of the property. So in 5 years, you're predicting what that cap rate is going to be. If it's 5% again, you're going to sell it at the same rate, but you don't want to bet on that. You want to kind of plan for, in 5 years from now, the market is going to be worse. So I'm going to sell it at a higher cap rate. So I'm actually going to get a little bit less for my property. So that's a conservative underwriting, right? If you plan for a more difficult market to sell it in 5 years, and you get a little bit less for your property, that's a very conservative underwriting. Because if the market continues to be great, you'll get even more for your property. So you want a higher reversion cap rate. So ask them for about a 2-point difference between the in-place cap rate and the reversion cap rate. So that's one of the rules by which, especially in Brad's group, we use. So the in-place cap rate is about 5 now. Then my reversion cap rate is around 7. The property I acquired, today is actually the 1-year anniversary of a property we acquired exactly today a year ago. And we underwrote it with a 7.4% cap rate. And we bought it at a 5 cap. So it was very conservatively underwritten to ride through a storm like COVID, you know, where collections could be less, etc. You might face other difficulties. And when it's an older property, you just never know. You buy it as is with no warranties. It's not like a new car, you know, that you get 5-year bumper to bumper warranty or something, right? So things can go wrong and cost you a big expense. Now, we of course have insurance on our properties, but if a storm hits my property and I have to replace the roof, my deductible alone is $50,000. So that's not a small amount of money. So when you underwrite more conservatively with a higher reversion cap rate, you kind of account for all these unplanned expenses that could happen. So that's a big one to watch for financially. If the market analysis is good and all the jobs and everything checks out, the next biggest thing is reversion cap rate and justifying the rent growths.
Yeah, for sure, because whenever you're getting an offer memorandum from a sponsor, at the end of the day, it's a marketing material, right? So, and every one of them is going to say they're conservative underwriters. And so you really need to dig into those indicators to make sure that that you really understand, are they really being conservative or not? And really take it as it's a marketing material. So that's why we always say here that education is very important. And these are, I mean, a lot of times the minimum is a $50,000 investment. So you want to make sure that you do your due diligence on the deal and on the sponsorship team, so you know what you're putting your money into. And Madi, you had a question about to get started with investing. Do you want to ask your question?
How to get?
Yeah, you were saying you haven't got any deals, and how can you possibly get investing? Do you want to? I'm not sure I understand your question. If you want to ask live there.
So I was asking, I joined a month ago and I'm learning a lot. As you guys mentioned, I'm studying the modules, I'm reading some books. I got a lot of quite information, but I'm just confused. How should I involve to get in deal and look at deals, how the deals are looking like actually?
So Madi, are you a personal mentoring student of Brad Sumrock, or are you in the foundation portion?
I'm in foundation.
Okay. So one thing that I think Brad made available, and you can certainly ask in the foundation Facebook page, he made available a lot of old past deals. So an easy way is to look at old deals that were for sale 6 months ago or a year ago that someone else has purchased. And you take that deal, you download the financials of that deal, and you try to underwrite it yourself. And then you can check back to see what price was actually paid for it, or what is a price you would be willing to pay for a deal which had these financials. Mm-hmm. That's a good way to analyze deals. Does that answer your question? Or are you asking where to find new deals to invest in?
Yeah, I'm trying to see where can I find new deals to do actually and invest in it.
So you want to be a passive investor in a new deal?
Yes.
Okay, you say those words and I can promise you at least 100 people will come to you within a 7-day time frame. So whoever is listening, let's add Mati to our passive investor base. Yeah. Let's develop a substantive relationship. There's a lot of people who might just meet you today and offer you a deal tomorrow. And unless that's a 506C offering, that's the only way they can make it available to you without getting to know you. So start establishing relationships with people and look for the posts on the Sumrock page for sure. And if you're within Sumrock Group, the best way is to make sure the deal meets that criteria, because there's lots of deals floating around that don't meet his conservative criteria. So don't be too much of a hurry to invest. Easily, we're still in August, you'll get at least a couple of deals before the end of this year, if not more. I expect at least a dozen deals to come through before the end of this year.
Yeah, and I can say, Madi, from my perspective, I think we always say that one of the most important criteria is a sponsor, right? I mean, the deal comes next, but the sponsor can make it or break the deal. So you start meeting people and starting developing the relationship on people who you know, you like, and you trust. I think that's important, right? So, and that's one of the reasons why we do these meetups here is we always try to bring speakers who they have experience being either a good passive investor or a good syndicator or both. And so every time you meet somebody, I suggest that you reach out to them after and you say, hey, can we have a conversation? And then, for example, when you have that one-on-one conversation with Sandhya, you understand what is important for her and how does she run her deals. And because not every sponsor is going to run their deals the same, right? There are some that are very big about community. There are some that are just about the money. There are some that they just want to have a deal and let it run because they have so many deals one after another. And so you really want to understand the different styles of the sponsors and see, like I said, who you know, who you like, and who you trust. So start developing those deep relationships and pick 3 or 4 that you feel like, okay, these people I like, and then do a background on them, right? So like I said, if you now you know, you met Sandhya, you can ask me about Sandhya, you can ask Martin about Sandhya, you ask 3 more people about Sandhya. If you get the feedback that, hey, Sandhya is great, now, okay, Sandhya it's somebody who you would consider evaluating a deal. Then you meet another person, do the same background check, go and ask 3 or 4 people about the one thing that I notice is when you ask these folks, especially in this group 101, everybody's very honest about giving feedback about people, right? They're gonna tell you, and you can ask who did you invest in the past? Like if you ask me, I'll tell you, okay, I invest with these people. If you ask Martin, he's gonna tell, Sandhya's gonna tell you, and you're gonna start seeing names that are starting to become familiar. That, oh, you invest with these people, Sandhya also invested, Martin also invested. So then you start creating that list of qualified sponsors, if you will, that will at least enhance your chances of getting to that first deal more successfully. And like Sandhya said, don't be in a hurry. I think you're going to start learning about sponsors soon.
And the one thing to remember is if you only have a bucket, let's say of this size of money to invest, and you invest it passively into 3 or 4 deals, then that's it. You're stuck, because for the next 3-4 years, that money is probably not coming back. So don't be in a hurry to invest. And another thing is, if you want to stay passive because you have a busy job and you have no intention ever of running your own deals, then pick 2 or 3 sponsors you like and put your eggs into 3 different baskets and then stay put. But let's say instead you actually want to use this as your learning tool like I did and eventually sponsor your own deals, then choose someone with whom you can develop a relationship saying, oh, I like this person, I like how they think, I think I want to invest with them to learn more about how they do business so that one day maybe I can co-sponsor with them, right? So choose who you invest with passively depending on what your goal is. Is it just the returns? Is it cash flow? Is it more money at the end of the investment and I don't need much of a cash flow for the next 3 years, but at the back end, I want a big return? That also influences the type of deal. But in terms of choosing the sponsor, again, what's your goal? Learn the business, see how a professional operator does it, or build a relationship, maybe somebody who's a little bit ahead of me so that they'll be my future partner. Or that's the market I want to invest in. Like for me, in my case, I wanted most of my deals in Dallas. So it didn't make sense for me to invest passively in a deal in Atlanta, right? So right away, it's like, okay, please don't bring me deals that are not in Dallas. I'm not interested, right? That's one easy way to kind of choose.
Yeah, I think that's a good point too, because as there are some sponsors that you're going to see that they're extremely experienced and they're doing a lot of deals, but they perhaps, because they're experienced, they have a lot of investors and they may not have enough time for you, right? They're not going to want to be picking up the phone every single call that you have and actually hold your hand. Now, when I sponsor that, maybe it's a newer sponsor, as long as they have a partner that is also experienced with them, they will probably be more willing to take your phone calls and answer questions and hold your hand throughout the entire process. So that's that's another thing that I think you need to keep in mind, that there are the pros and the cons of getting somebody who is extremely experienced but may not ever have the time to pick up the phone versus somebody who may be not as experienced, but as long as they bring other partners to bring that experience, that they may be able to hold your hand a lot more.
Yeah, maybe also if I know you only joined the group a couple months ago, you've been to a few of these meetups, so you've met maybe 3-4 sponsors here. Try to leverage the networking in the group. So whatever group it is, in Brad, there's every couple of weeks there's a meeting, a WebEx, basically a Zoom meeting with him and pretty much every student's there. So try to leverage that. Try to find sponsors that are speaking out on the chat, putting their information, things like that. If it's a different group, if it's not Brad group, I'm sure they have some type of networking environment, especially during COVID online. So try to leverage that to meet the most people you can, and then go through the whole vetting process to see, okay, out of these 20 people that we met that are sponsors, which ones are the 2 or 3 that I'm gonna focus on, that are gonna be like the people I really like and really have similar goals to what I have, right?
And keep coming to this meetup, because
Yeah.
we're gonna have great guests in the future, and we've had also great guests in the past. So you can watch the recordings and
reach out to them,
be more familiar. You can reach out to them and be more familiar with the terminology and their stories, how they do it, what's their background, etc.
Yeah, just watching our webinars, we have 18 so far. So you have 18 people there you can reach out to, and they're going to be happy to reach back to you and make a connection.
Yep, for sure.
Rubio, this is Ganesh. Quick question.
Sure.
Can you guys share the contacts, or is there any easy way to reach you guys if I have any questions? You have some experience, Marcelo has, and
yes. So Ganesh, at the end of the presentation, we'll share our contact information from Martin, myself, and Sandhya. And then I posted the link also to our YouTube channel there, and I'll post it again. If you go to our former presentations, at the end of it, we also have the contact information of the guest in there.
Perfect. Thank you.
And guys, you can exchange information on the chat between yourselves too. If you want to post your information in the chat,
yeah, or if
you can. No, go ahead.
Or if you saw like someone else here besides Marcelo, Sandhya, and us that you think, okay, these people is in a location that I'm interested on, or I really like the question they asked, or something like that, you can either publicly or privately through Zoom send a chat comment, just send them their email or your phone, and you can get started there. Just try to network as much as possible, because this business is all about networking. Just not only sponsors and investors, but brokers, lenders, property managers. It's all networking. So don't stop doing it. Yeah.
All right. So does anybody have any other pressing questions? You want to know more about the business? And give everybody a minute to see if anybody have any other questions. And while you do that, let me, I'm gonna give you guys a poll to answer in terms of what can we do better on this meetup or different. So I have a list of topics in there that we came up with. So what are some of the things that maybe you wanna learn more about being a passive investor? And then if there is not an option there, feel free to just type it on the chat. So let me give you guys that option, and then you can take this time to see if you have any other questions for Sandhya. So are you trying to know more about how to find deal sponsors? I mean, how to evaluate a deal? Do you know what a K1 is and how to review it? What are some tax implications? Depreciation, cost segregation? Do you know the difference of being an LP, KP, or GP? Do you want to know more about multifamily terminology? I mean, we were talking about economic vacancy, reversion cap rate, or if you have other topics there that you'd like to learn more. So.
Hey guys, my name is Jaspreet. Joined a few of your meetups before. I wanted to ask, how do you guys, people who are new or have done one or two deals, if let's say you get a deal through any of this deal pool, I don't care if it's CBRE, Marcus Millichap, or offline deals or Facebook options, there's just so many people that are sending you deals to evaluate. And you have bought one of these spreadsheets online, or you use Bigger Pockets, or you use something that you created on your own. You do the underwriting and you say, all right, you know what, I've spoken to a couple of lenders, I've gotten a good idea around what the interest rates are going to be. I've done some market analysis, city data, online other websites, and I know what the vacancy rates are for the market. I know what the cap rate is. This is the price I'm ready to offer, and I've even spoken to a few other in people that are interested in investing, maybe through me or others, but they're interested in investing, and I want to create something that's marketable. You want to create a PPM, you want to create some sort of a marketing material where it's easy to understand, enough information, open and honest. Have you guys straight away gone to a marketing company and given them the information and said, make me a PPM? Have you guys bought templates offline? And I know some of you guys are already in groups where you may have access to their templates that they use, but how do you guys approach that marketing piece of stuff where you have a substantial relationship already and you've known these guys for 3 years, 6 years, 3 months, whatever it is, you have enough relationship, but you want to start presenting the information beyond just the 5 pieces of things that says purchase price, unit count, location, potential IRR, potential cash on cash, duration, and that's it, right? You want to have a lot more information in there, and you can borrow some stuff from the offering memorandum that you get from the brokers, but how do you really create that great layout and make it presentable so that people want to invest and get everything they need?
So in our experience, basically what everyone's doing is following the offering memorandums that we've seen when we were passive investing. Right? So that wants to syndicate, what you're doing every day is learning about ideas and thinking, how can I do this better when I do it? Like if it's reporting to my investors, how can I do it better? Same thing with the offering memorandums. Okay, when I pitch my deal, I'm gonna use this idea, I'm not gonna use this idea. And basically the offering memorandum is just a very powerful PowerPoint presentation showing everything that you want to show about the deal, all the strengths. Maybe if there's any weaknesses, you can show how you have the team and the experience to manage those weaknesses. So it becomes a selling document. So you have to know how to make it appealable for investors without being like a corny sales pitch. The PPM, it's a legal document, so it needs to be drafted by your attorneys, your SEC attorneys, and they're going to require you to present that selling document, that PowerPoint presentation that you use to present the deal to your investors to draft the PPM. And you're not supposed to show that presentation to anyone until you have a PPM, because the PPM is basically the legal document saying that what you promise on the presentation is actually true. And when an investor actually invests on a deal, they need to go and read the PPM, because the sponsor could have said something different on the presentation. What's really valid and what's going to count if you have to go to court or something in the future, it's going to be the PPM. So you have to do that mix between the sales pitch on the appealing, visually attracting document, and the PPM, which is a very dry legal document, just word. Imagine a Word document, 75 pages of just letters. So it's a mix of those. I haven't heard of anyone using a marketing company for it, and I think it's basically because of the time constraints. When you're in the deal, you want to get that PPM out as soon as possible, so you can present your presentation or do your webinar as soon as possible. So I think including a marketing company would delay the process, unless you're a really big company and you have your own marketing guy inside in your own firm.
Yeah. Do you want to add anything, Sandhya?
Yeah, pretty much. I look at the presentations that I have received as a
From
passive
your
investor, and I take the things I like from other people's
Sandhya.
presentations and try to add that to my own. And then, of course, the PPM and all the legal stuff is taken care of. It's a whole syndicator package that typically the law firms give you, whoever you pick. So they take care of all the legalities and to make sure that our, what we say in the webinar is valid. So we also record the webinar, but it usually has a lot of the things borrowed from the broker in terms of the market, but then the deal and the deal analysis itself, you want to put your own spin on it. So for example, if the sponsorship team all have skin on the game, in terms of we're all putting in at least the minimum investment in this deal, you definitely want to say that. You want to show a clear summary of what is the cash flow a passive investor can get. So for 100K or 50K, this is what you can get year 1, 2, 3, 4, and 5. This is what we expect to sell it at. This is what the sponsor gets compensated. Be clear about that. And if you're a passive investor, for sure, understand the sponsor compensation, because there are so many different ways that can work. Some of them might just give you a specific percentage as a return. And once they hit that percentage, they might take the split from a 80-20 or a 70-30. They may even go to 50-50.
Yeah.
So you want to know
And
that.
also,
The other thing you want to know at the beginning is the acquisition fees.
Mhm.
Some groups charge outrageous acquisition fees. So on a $10 million fee deal, they want a 3% acquisition fee. That's a lot. So I try to find sponsors who don't charge any acquisition fee, or if they charge a fee, it's less than 1%. 1% is the most I would pay.
Yeah,
So
or how do
acquisition
they-
fees and sponsor split is another important thing for a passive investor to know, and an important thing for a syndicator to make known to their passive investors.
Yeah,
If
for sure.
if they are charging any acquisition fees, why is that? What was the story behind? Do they have a lot of experience? Was it very difficult to get the deal? Also, there are other fees like disposition fee, and we've seen refinance fee, and those things should be clear in the offering memorandum for the investors.
Yeah, for sure. So one thing I want to just mention to you guys, I posted the link a couple of times on the chat. So if you guys subscribe to our YouTube channel, that does help us a lot. And then you get notified if you miss a meeting in the future. And then if you also want to go back to our past meetings and meet other sponsors or other passive investors, I think you will like having that. And I just want to mention for the folks who are new here, we meet twice a month. On the first Wednesday, we focus on how do you get started as being a syndicator. And on the third Wednesday, we focus on how can you get started or get better as a passive investor. So our next meeting for syndicator is going to be September 2nd, and then we'll meet again September 16th. And I do want to share Sandhya's contact information again. Sandhya, we really appreciate the time you spent with us. And I just want to remind everyone that on Sandhya's website, do you want to tell them, Sandhya, what they get by going there and entering their information?
Yeah, so my website is multifamily4u.com, where 4 is the number 4 instead of spelled out, and the U is spelled out. Multifamily number 4you.com. If you put in your name and email address, I will send you a checklist to vet a sponsorship team that I have developed from all the different deals that I have invested in. And then subsequently, you can choose whether or not you want to get any more emails from me, or that's it. You want to get that one thing and stop. But my website has some information on my background, etc. as well.
Excellent. So multifamily, the number 4u.com, like you see here. If you want to take a screenshot on the screen, you're going to have the website there. And I've heard it's a great checklist for vetting the sponsor, and that's always something you want to be very good at is vetting the sponsor.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.